Hello and good morning or evening if you're watching this at night. I am Mindy V. Terry. I'm with V. Terry Accounting and Financial Services. It is March 24th of 2020, which is why I have a funky looking wall behind me. The reason that my wall looks funky is because we are in the middle of the COVID-19 or coronavirus chaos. And so rather than having a nice wallpapered background, I have this crazy background, so please forgive. Hopefully it's not too distracting. But we tried to do a live feed today to kind of walk through a financial statement tutorial, and we were having a lot of technical difficulties. And I imagine just there's a ton of people out there doing feeds. So with that in mind, instead I'm just going to record this video, and I'll make sure that everything is kind of put together a little bit better, and then you can have something that you can walk through at your own pace, especially being that, as my mother likes to tell me, that I speak at 90 miles an hour. So you can pause me anytime you need. So first off, thanks for watching the video, we're going to kind of go through the basics of the financial statements, but prior to that, let me start with just introducing myself. I have worked in accounting for over 25 years. I have been in over 50 industries. As you can see here, this is kind of a pop-up list of all of them. And not even all of them. My husband keeps pointing out different ones that I've worked with. As far as the sizes go, I've worked from small mom and pops to a one-man show, all the way up to Fortune 1000 publicly traded SEC companies. And then I'm also a business owner, so I know what it feels like to be a business owner and wear a bunch of hats and have to manage all these different pieces. So one of the things that you have to do as a business owner is to make sure that you understand the financial aspect of your business. Even if you are the CEO of a major company in the world, you still need to know what is being reported to you financially. So because of this, we want to at least be able to receive a financial package from either a bookkeeper or an accountant or a CPA or whoever's working on it, and read it, make sure that it makes sense, because we know our businesses better than anybody else. So I know that if I'm, regularly pulling in $50,000 a month, and at the end of this whole thing, I see revenue of only about $100,000, there's a problem, and I've got to go back and go there, this doesn't make sense. I know what my company does. I know the revenues that should be coming in. So we'll kind of go through all of that and just understand how we can read our financials and make sure that, we just feel like we're more comfortable with it. So before we jump into the financials, there's several levels of need in business. So if you fall into the following, then I advise you to go with a firm. Okay, like my own, you can go with somebody local who can advise you and help you walk through the financial aspects of your business on a week-to-week basis to have positive impacts on your business, your life, and the lives of those that you service and employ. So if your business has reached the point where it's too complicated for a simple couple hour a month bookkeeper to keep up with, then you need to, and you need to make strategic decisions based on these financial statements. You are in this level of business where you're going to need some assistance. You may have payroll. You are a contractor with projects that run more than a month long. You really need to make sure that you have an accountant there to help you with that, because it's not as easy as just I can put it on my books when I pay for it. If you have inventory, then you have to be in the accrual method of accounting. You cannot use the cash method per the IRS standards, and I'll go into that a little bit later. So if you have inventory, you better make sure that you have somebody who is knowledgeable of what's called GAAP, or generally accepted accounting principles, who's helping you to maintain your books. If you have a C Corp, you have to also be on the accrual method. If you carry more than $1 million per year, it's advised to have an accountant or an extremely knowledgeable bookkeeper helping you. But if you have more than $5 million a year in gross revenue, you absolutely have to be using the accrual method again. Also, if you just feel like you don't have enough understanding and visibility into your books to make financially educated decisions on your business, then at that point, that's when you also need some help. The help that you need preferably will come in the form of a degreed accountant or firm, so that you can be sure that they have been educated in generally accepted accounting principles. However, I have known a lot of bookkeepers that were very well versed. Just make sure that you test them out and that they know what they're talking about. So now that we've talked about what you need as far as your services go, let's talk about the financials and what they mean to you. Even if you are just starting out, you need this information. Now, why? Why do I need this information? Well, first, if you ever need any type of business lending, lenders will expect you to not only provide them with the financial statements, but possibly be able to explain it to them. If you can't do this, they're not going to take you as seriously as you would hope that they would. The second reason, fraud. Guys, I hate this, but I have run into way too many circumstances where I'm coming behind a situation where whoever was running the business's financial services was not as honest as they should have been. And sadly, more times than not, and this is just what I've seen, I have to state it as fact because it's what I've seen, it was a family friend or a family member that was doing it. And we all think it wouldn't happen to us, but those are the ones that come to me later and say, man, I wish I knew. This is one reason why my firm is insured, and you need to make sure that you go with somebody that is insured. Okay, and then the third is to be able to understand your business and how successful it is. Guys, if you don't know the score of a game, how do you know who won? So your financials is your company scorecard, and it's imperative for you to have this scorecard accurate and be able to understand it. So let's dig in. So here are some terms that we're going to start with. P&L. And I'm just going to run through these really, really quickly because we're going to dig into them more. But P&L is also called an income statement or profit and loss. And this is basically how much money did I make this year? It's a statement that you get in your financial package. How much money did I make, right? And it's this year to date, this month, it'll show you that. The balance sheet, this is also another statement that you get. It's basically telling you, what is my business worth? Okay, what do I own less what do I owe? All of that gives you the book value of your business. This is not an actuarial valuation of your business. That can be totally different, very, very big difference. But this is more the book value. And then let's see. So we go on. We've got the cash flow statement. This is where did my money go or where did it come from? Asset, this is what I own. Next one is liability. This is what I owe. The equity is who owns the business. Where is the ownership in the business and what is the book value of this business? Revenue, this is income or sales of services and products. This is the actual sales price, okay? Expense, that's the costs of either the products and services that you're selling or the cost of any goods or services, labor, things like that have gone through the business. Cash versus accrual. Again, this is what we were talking about earlier, to where if you have certain parameters that your business is in, then you have to be on the accrual method rather than the cash. But you also need to know the difference because sometimes one is more tax advantageous than the other. But these are different types of accounting methods. Once you choose one, you have to stick with it. The IRS says very clearly, you choose that one, that's the one you do on your books, your taxes, everything. Now, can you change it? Yes. And I've done that several times for a lot of my clients, had to switch them over to a new method. But you have to know what you're doing in order to do so. The next three terms are all terms that you're going to find on the cash flow statement. The first one is operating. It's the basics of running the business. The second one is financing. These are the funds that come in or out of the business outside of your regular operations. And then investing. These are funds that are put back into the business in the way of asset purchases like equipment, vehicles, things like that. Again, we'll dig into all this a little bit more. So let's start with the first one, which is the P&L or income statement. Okay, and this is the statement that tells me how much did I make, or sadly, how much did I lose? So this is made up into three sections. The top section is what I like to call top of the line. And that is basically your revenue or your income and your COGS. Okay, so let's go into those a little bit. So the revenue or the sales that you've made. So the sales that you have made are the products and services. It could be either one. This is anything you've sold that is a part of your regular operations. It has to be really what you do. Can't be something that's just on the side and your business is, say your business is manufacturing and you on the side rent out a small space. That small space is not a part of your revenue because that's not what you do as a business. So your revenue is your income from regular operations. Your COGS. Okay, so COGS means cost of goods sold. You'll also see it as COS or cost of sales. This is what that product or service cost to get it from you to the customer. So if you are selling widgets and you sell those widgets for $10, $10 is the revenue. If the widget cost you $5, or let's go $6 was your cost, then the COGS is $6. Okay, so your revenue was 10, your COGS is 6. So let's see, once you get past that point, then we'll go into a few more in more detail again, but let's go to the next big section. So that's top of the line. The next big section, the second one, is OPEX, or operating expenditures. This is the cost of doing regular business, okay, above and beyond what the COGS is. So this would be rent, it would be payroll, it would be insurance, anything like that. Those are all operating expenditures. This means that if you didn't sell anything that day, you're still going to have these expenses that you have to pay. Because like right now, where all of us are kind of stuck at home, if we have a brick and mortar business, I doubt that you're not still going to have to pay your insurance and your rent or your mortgage. You're not going to have to pay the salaries for the people that you have. These are all things that are going to continue to move forward. You still have these expenses. Now, sometimes they can be off or on, depending on your activity level, but they are outside of just the cost of that widget. It's above, it's taking care of all the rest of the operations of your company. And then the third section is other. Okay, so this would be like other income, other expense. So an example of this would be anything, like I said earlier, outside of the normal income or expense of your company. So again, revenue would be the manufacturing that you do. The other income would be that space that you're leasing out to somebody because you didn't need so much warehouse space. Okay, so how do I read this report? You know, that's great. You told me what all these are. So how do I use this? Well, first, the top of the line, it's going to show you both your revenue. Again, that's going to tell you how much you've been selling. It's going to tell you what are your trends over time. So you get this report and it shows month to month. You should see your revenue hopefully going up over time. But sometimes if you are a seasonal and you know it, you should see seasonal peaks. So say you're a landscaper, okay? Most landscapers, their busy season is the spring, summer, a little bit of the fall, right? Most of the time, by the time the fall hits, it kind of starts tapering off. So you should start seeing like around April, right? Everything going up. Your sales should be climbing, and then you'll see it back down in the wintertime. If you're somebody that's retail, it could depend on the sun, moon, and the stars, depending on what is going on in the market and how people are spending. So you could see little peaks depending on, you know, maybe your marketing. It's just a type of sale that's not, it can be a little seasonal, like bathing suits, things like that. So just, you know, whenever you're looking at that P&L, you should be able to see the trends of where your revenue is going. Now, that's just your sales. That's just the sales price. The next piece to that is your COGS. And like we went into earlier, this is the cost of getting that product or service to the customer, right? So if you have a service, a lot of people are like, well, I just perform this service for people. I'm an electrician, so I just go out and I do this job, or I have a team of people. Well, a part of the COGS is the product or service that you sell. So if you have a team of electricians and that is your business, then their labor as they go out to these customers is a part of your cost of sale, because what you're selling is their services. It's the labor that's going into it. But if you are a manufacturing facility, and you have labor that's in the front office that takes care of your books, or is the receptionist who answers the phone, she's not getting that product out the door. So she would not be considered a cost of goods sold. She's a part of your operating expenses, because it doesn't matter if anything is made, she's still going to get paid for what she does. She has no part of actually putting her hands on this product and getting it out. So then once you take your revenue, and now you have your costs, you take your revenue minus your cost, and that is leaving you with a line called gross profit. Now, most often we hear net income when we hear people talk about a business. Is what's your net income, or my net income is this. What is gross profit? Well, it's the difference between the sales price and what the product costs to get it out the door. So let's go forward. So that's our gross profit. That's top of the line. Now we're going to move on to OPEX, or operating expenses. Now, what is operating expenses? Now, that's again the cost of operating your business. So do you only have you and your products, well, then a lot of times you're not going to see a whole lot in operating expenses. Maybe you'll just have business insurance, maybe some travel, equipment expenses like internet, computers, things like that if you absolutely need it, auto reimbursements if you have to travel to maybe do some marketing, things like that, advertising costs. It's very limited a lot of times if it's just a sole proprietor and it's just a tiny little product. It's like one thing out the door, or even if it's a ton of products but it's drop shipping, it's just straight out the door. You don't have a lot of overhead. Now, on the other hand, say you have a full staff, a brick and mortar business, say you're a retail shop, then you're going to have a full section of operating expenses. And if you are getting your financials and you don't see a full section of operating expenses, there's a problem. So these operating expenses are going to include things like your rent, your labor, your insurance, your phone, your internet, the maintenance on the building, any of this that is not a direct cost to that particular product. Now, we have the operating income or the loss, which is basically you've taken the gross profit. Now we're taking out all those operating expenses, and that leaves us with an operating income. Now, a lot of times you'll just see it stop there. Like the operating income is also the net income. And if people use QuickBooks, a lot of times that's what they see because QuickBooks kind of lumps things that a lot of accountants would consider other income or expense in all those OPEX categories. So if you see that, it's not the end of the world. That's okay. But if you have an accountant doing your books for you, a lot of times you'll see that it goes a little further. So you've got your operating income or loss. This is the gross profit that we mentioned, right? Less all the operating expenses. This is what we have left over, right? Now, finally, we have other. Now, the other is the odds and ends that don't fit into the business. Normally, this would include things like interest, taxes, but also you could have income or expenses fall outside the normal course of business like we've mentioned. So again, if you're a manufacturing facility, you manufacture those widgets and you sell those widgets and that's what you do, but you have about a fourth of the building that you just don't need, so you lease that out to a little office that needs it. That lease income that you're getting is not a part of your revenue. So we're going to put that down in other income. It just kind of goes down at the bottom. So it still goes into your books, but it's not throwing off your numbers at the top by making it seem like, ooh, I'm making so much money, in my business, course of business, when that may not be the case. We want that down in the bottom so that we can see truly what are we making from the course of the business, and then what are we making from other things as well. And then finally, once you take out or add in your other income and expense, your ending balance is your net income or your net loss. This is how much money you have made as a company. This only accumulates within a fiscal year. Okay, this is very, very key for people because a lot of times we don't know this. So once the year is over, the overall net income, all those 12 months are added together, all that net income, and it rolls into the balance sheet. So how in the world does it do that? So let's go on to the balance sheet and we'll see. All right, so again, three main sections of the balance sheet. You've got your assets, what you own, the liabilities, what you owe, and the equity, which is your book value. It's the difference between those two. Okay, so assets. Assets has different sections, as you'll see with all of these. Is pretty much all of them kind of run this norm of current and non-current. So the assets are normally listed out in order of liquidity. And this is basically how quickly we can turn that asset into cash money, right? So what's our first one? Well, the first one's going to be cash. It's going to be our bank accounts. Then the next one is normally accounts receivable because those are normally turned over within 30 days, if not shorter. Then normally you'll have inventory, other current receivables, like say you have employee advances that you've given to people. That's kind of like a receivable and it should be returned fairly quickly. Normally non-current is within 12 months. Now, sometimes I've seen people put something in long-term that's a little shorter than that, like 6 months. Your standard is 12 months is what you really want to see. So the non-current or the long-term would be things like fixed assets, like equipment, software that will last you more than a year. Automobiles, buildings, anything like that. That is things that are going to be long-term assets. It's going to take you quite a while to turn those things around and turn it into cash. Next, we have notes receivable. These are loans that you have issued out as a business to someone else. You see these normally as a loan to a shareholder, or maybe even loans to employees, but it's a longer term than a year. Finally, one of the other long-term ones would be goodwill. If you've ever seen this, I'm not going to go into great detail because it can get a little complicated, but it's basically if you have acquired a business, if you've purchased a business, so this business has purchased another business, or you purchased this business, it's what you paid for that business above and beyond the value of the assets that the company has less the liabilities. So you remember how I told you that assets less the liabilities gives you the equity or the book value of your company? Then if you go out, say the book value of this company is $100,000, but they went out and had an actuarial company evaluate their company, and they said, well, it's actually worth closer to 250 because it's very popular, it's a very moving business, it has a lot of potential, you've been putting a lot of money into it, so there's a big net loss that's been carrying forward for some time, but it's growing and it's gonna boom, here soon, just from what we're seeing in the market. So the value on the business is 250, the book value is 100, that means $150,000 goes to goodwill. And then it gets complicated after that because we have to check every year whether that value has gone up or down, but that's basically what goodwill is, and that's why you'll see it on books. Okay, so next let's go on to the liabilities. So the liabilities, it's what we owe, right? And these again are current and non-current. So what are some current ones? Well, those would be things like accounts payable. These are bills that you've received that you have to pay out to your vendors. You've got payroll liabilities that are normally, kind of short, that roll over after the last month. Sales taxes payable, if you have to deal with sales taxes. These are all just small payable accounts. Then you'll have things like non-current or long-term liabilities. So what would that be? That would be more like a note payable or a loan or a lease. So if you're working with an accountant, then they will probably take those loans or leases and they're going to separate them into what portion of it is short term and what portion of it is long term. It's not the end of the world if you don't do that, but normally an accountant will separate those out for you so that you can kind of see the differences in what is due right now versus what is due much further out, because a lot of times we can even have 30-year loans, especially with all these SBA ones going around. Okay, so then the final section of the balance sheet is the equity. So the equation is assets minus liabilities equals your equity, right? But we don't just put a number down there because we want to know what in the world is this equity made up of. So what would that be? Well, it's made up of the funds that are invested into the company, and say you're a partnership, okay? So what you will normally see on your books is in the equity section, you will see partner draws, you will see partner equity or investment, then you'll see retained earnings and net income, and we'll go into those two in a second. So the draws is anything that you have taken out of the company. So say you're a sole proprietor and you don't have a bank account or anything like that for the business, it's just you. The way that it works is that everything that comes out of the company goes through me. I pay in, whatever covers to all the expenses, but all of that shows up as basically a draw in the company, so that in the end there's no net income that's sitting in the books. It's just kind of sitting there at the end with nothing left. So those draws go into this equity section showing, okay, this is what she's taken out of the company. If I've put anything into the company, say you're again like a retail and you need $100,000 just to get the building up and going, get the equipment in, get a stock started, get the insurance started, all of that, get beginning wages for employees, you need some upfront cash to put into this company. If you put in personally $100,000, even if you take a loan out, but it's in your name, then that is an investment you personally have made into the company, and that shows your ownership in the company. It brings value into the company. So that is going to show up as an investment. So you'll have your draws and your investments. If you are a C Corp, it gets a lot more complicated because you'll have shares, you'll have common stock, you'll have preferred stock, you'll have additional paid in capital. It all gets a little sticky when you get to that point. That's why you really want to make sure you have an accountant who knows what they're doing, who understands equity, understands C Corp equity, how to maintain a capitalization table, all of that. So you need to make sure that you're dealing with somebody who knows what they're doing if you have a C Corp. Or if you're working in a situation where you have shares and stocks and things like that. So back to kind of the partnership idea or a sole proprietor idea. So you'll have your draws, your investment. Finally, you'll have your retained earnings. Now, remember how I told you that the net income only carries for a year, and then all of that smushes together and it rolls into the balance sheet, and then it basically clears out the P&L and you start all over again with the next year. So where does that money go? Well, that money goes into retained earnings. Now, if your books are maintained properly, then the only thing that should ever touch your retained earnings is one entry a year. At the close of the year, net income rolls from here into retained earnings, and that's it. It doesn't get touched again for an entire year. So that every single balance sheet that you look at throughout the year, the retained earnings stays the same. It's just everything that happened before. So if you look at your retained earnings, and this is a company that's been open for 5 years, that retained earnings tells me how much money they have made or lost over a 5-year period. So that's all that retained earnings is. It's showing the value of the money that's been kept in the business for so long, okay? And that's basically how much you've made or lost. Then you have your net income for the current year, and that will continue to change until the year is over, and then it'll again roll into retained earnings. So that's the 4 pieces that you will normally see in equity, especially if you're a sole prop or a partnership. If you're a partnership, you're going to see multiple lines. So you do not, please, if you're a partnership, do not let anybody put in your books everything going to investment and everything going to withdraw and everybody's just in one big group. You don't want that. I have dealt with so many partnership disillusions where they just get furious over this because you're not able to see the true ownership of the company based on the investment that I've put into it. I put in this much, I want to be able to pull that much back out, and it just went into a big pot. And guys, this happens with family, and it's awful, and I hate to see it. So you need to make sure that every person who is a partner has their own accounts. So you should see a line for Joe Smith that says this is how much he added in and this is how much he took out, and this is for Brian Smith, his brother, who is his partner. That's how much he put in and how much he took out. And then here is Mary Black, and that's their sister, and you want to make sure that you see what she put in and what she took out. Everybody needs their own so that there's no question as to what you personally put into this business and what you took out of this business. Believe me, guys, you want to keep that straight. Okay, so let's jump out of the balance sheet. We're going to go over to the cash flow statement. So a lot of people, man, when they get their financials, this is one of those statements they just blow over. It's like, oh, it's too complicated. I just don't even want to look at it. But if you know what you're looking at, you really need the statement. So what is the statement? It's telling you, where did your money go? You have no idea how many times I have talked to different business owners who say, well, I just wish I knew where my money was going. It's just, I see all this coming in and it seems like I should have money here, but I just don't know where it's going. This is where you need this, okay? The statement is divided into 3 sections. Like I mentioned earlier, you've got operating, you have investing, and you have financing. Now, I'm not going to get into the details of the statement because it gets very complicated. And if you are not an accountant, you're going to glaze over on me and you're going to go into happy dream world. So we don't want that. So I'm just going to tell you as a business owner how to read it, how to understand it. And we're going to keep it very simple. So just operating, it's how much cash this month, this year, this quarter, depending on how long the statement goes for. Okay. How much did I make? How much did I lose by way of my day-to-day operations? That's it. Okay, your net income, the day-to-day operations, the expenses that are coming in and out, and this is all cash. Okay, it's the day-to-day operations. How much did I lose or how much did I make just from that piece? Then you have investing section, and investing is how much money did the company reinvest into itself, or how much did it lose from invested assets. So this is basically like, I have a manufacturing facility and I need to buy a big $50,000 piece of equipment. So if I went out and I paid, so much money for this piece of equipment, then that equipment is going to go into this investing section because the business just invested into itself by way of a big asset. Financing section. This is how much cash did I or others, like other owners, invest or take out of the business. So this is again those draws in the investment. So that's one way. Also, how much cash came in or out of the business by way of lending or leasing. If you're paying loan payments or lease payments, they're going to be in this section. If you get a big financing round, like stock sales, even if you have options in your company, it would be here. If you've ever heard the word series rounds of funding, say you're somebody who needs to go get some angel investors or private equity, VC capital, any of that, then you will have to go through these series rounds of funding. Any money that you get from these investments will go into this section. So financing is basically what is financing your business. It would be you, it would be lenders, leases, it would be stock sales, things like that. So that's what is financing the business to continue to run. And this could go up or this could go down. If you're paying loan payments and you haven't gotten any other financing flows in, then it's going to be a decrease in your financing section. If you're getting a bunch of money in from stock sales, then you can see that this would be an increase in cash. So now you know the basics of the financial statements. You should be able to take a look at your own financial statements and comprehend the ins and outs of what you're looking at, okay? Now understand this is a basic overview. So to understand, you will need a bit more to truly make good decisions from your financials, but that's where the experts come in. So let's talk about one more area, and that is where, again, experts will be able to explain this to you as well as implement this in your books, and that is accrual versus cash accounting. So when do I have to have the accrual method? Well, like I mentioned earlier, if you have inventory, you have to have the accrual method. Now, there are exceptions to the rule, so understand that this is not black and white. There's always different things that can or can't happen, but for the most part, if you have inventory, you need to be on accrual. If you are over $5 million a year, you need to be on accrual. If you are a C Corp, you have to be on accrual. So these are different types of situations where you need to be on accrual. My advice is that almost everyone be on accrual if you have a business that is more than just you running a sole prop. The reason I say that is because what does the accrual method do for us? Well, it lines up our revenue and our expenses to where they are matching appropriately and it makes sense. So why would I say something like that? So what is cash versus accrual? So let's go to a basic example of, say you need your computer fixed, right? I used to say copier, but that was like 2 decades ago, and that's not really good. So, so if we need our computer fixed, we have, some guy come in at the Geek Squad or whatever, and they come in and they fix the computer. So they come in, today's date's March 24th. So they come in on today and they fix my computer. And that blasted thing was a mess. So it cost me $200-300, right? So let's say $200. So the guy says, yeah, it's going to be $200, but you have credit with us, so they'll bill you because I've worked with them for a long time or something like that. Cool. All right. So he gives me just basically a little receipt of the work and says it's going to be about $200, and I'm like, cool. Okay. So I have that. So now I don't get the invoice from this Geek Squad group until, say, April 5th. So on April 5th, I get my invoice. They say it's due upon receipt. So I turn around and I pay it. So the cash goes out maybe on April 8th, April 9th, somewhere around in there. And that's it. I've paid it and everything's done and everybody's happy, right? So if I am on the cash method of accounting, what that means is when the cash moved that's when I'm going to book the things in my QuickBooks or in my Excel sheet or whatever. I'm going to put that date, the date that the cash moved. So when I got the invoice is when I'm going to put my payable in the system. When I paid it is when I'm going to put the expense and the cash in the system, and I'm done, right? Everything's finished. The problem is that the expense was incurred back in March. My invoice and my payment wasn't until April. So if you were on the accrual method, then what you do is you have to book things not when the cash moved, but when the expense or the income it was incurred, when the expense was incurred or the income was generated. So that when that computer is fixed, if I'm on the accrual method, I'm going to take that little $200 and I'm going to post that in my system. Now, I'm not going to explain how because that's complicated, but I'm going to post it in the system so that my expense hit the books in March, not in April. And then later, other stuff is booked in April to deal with the cash, but the expense needed to go in March. This is where accounting is needed, because this is where your accountant knows how to book those things with the debits and the credits, and that makes people's heads explode. Believe me, my husband, he said I had to take accounting 101 and I never wanted to look back. It was the most horrifying experience of my life. But for an accountant, it just clicks. So that's what we're here for, is to put those debits and credits in the right places so that we can make sure that your revenue and your expenses are in the appropriate periods, which is when they were incurred. That's what you want, is when they were incurred. So these are the reasons why it's so important that you have an accountant who can keep you on the accrual method if you are more complex than just you and a product or service. Again, just you should think about what level of business that you're in and choose the help that's needed to ensure you're set up for success. Now, if you think that we could assist you, you are very free to give me a call. You can ping me through Facebook, through YouTube. You can hit me up through text, whatever. My number is on the website. You can go to our website and just kind of check it out, see what we do. I will do initial consultations for free, just so that we can kind of walk through where you are and how things are looking, and maybe even answer some simple questions. But feel free to touch base with me. I want you guys to be successful. There is no reason why a business shouldn't be set up for success if they surround themselves with the proper inflow of good advice and good information. So again, thank you so much for watching. If you need to contact us, the information is in the description below, including the contact information for me personally. And hopefully you guys can take this and run with it and know how to read your books. Everybody have a good day.